Founders Forum, episode 22.
Open your mind to a new episode of the Founders Forum, the podcast championing a free economy, sound assets, and blockchain solutions. Each week, your hosts, entrepreneur Cole Snell and economist Bob Murphy, interview pioneers and free thinkers to help you develop into the architect of your future.
Hey everybody, welcome back to another episode of the Founders Forum. This week, I am going to be flying solo. I mean, there's a passenger on the plane, but I'm saying just me as the pilot. I don't have my co-pilot with me. Cole has to attend to some other matters, so I am happy to host myself to just have the discussion with Lawrence H. White, who was our guest this week. Let me just read a little bit from his official bio. He's professor of economics at George Mason University, best known for his work on market-based monetary systems. His new book is Better Money, Gold, Fiat, or Bitcoin, and that was published in March of 2023. That's what we're going to be talking about in this episode. But Larry is also the author of The Clash of Economic Ideas. Let me just mention parenthetically that I used that. Some students, when I was at Texas Tech, we went through that book. It's great just to give you a quick summary of different viewpoints in economics. That's why it's called The Clash of Economic Ideas, just showing different schools of thought or different economists and how they approach things from their own unique perspective. So it's a good eclectic mix if you want to get up to speed on some of the controversies. Another of his books is The Theory of Monetary Institutions and also Free Banking in Britain, and then also Competition and Currency. Larry's research has appeared in the American Economic Review, which is the top-ranked economics journal, the Journal of Economic Literature, the Economic History Review, and other leading economic journals, and his popular writings have appeared in the Wall Street Journal and elsewhere. And he's also an editor at the journal Econ Journal Watch and hosts their bi-monthly podcast. So what Larry and I are talking about in this episode, as I said a minute ago, is his new book, Better Money, Gold, Fiat, or Bitcoin. I think you'll find it very informative, that he just summarizes a lot of, it's from the perspective of the United States primarily, but the gold standard, then the different stages, the breakdown of the gold standard in stages, and how it went from the classical standard to the post-war Bretton Woods arrangement, and then finally the true fiat paper money standard from 1971 onwards. And then at the end, we talk about Bitcoin and the different ways of looking at Bitcoin from the viewpoint of monetary economics. And we compare and contrast the performance of those three different types of regimes, if you will. So I think you're going to find it interesting. And at the very end, if you're a business owner, I do ask Larry a question pertaining to you folks. So this isn't purely theoretical or academic. It does have news you can use at the end. So without further ado, here is my conversation with Larry White. Larry, welcome to the Founders Forum.
Thanks, Bob. Good to be here.
So I think the most natural thing to do in terms of us diving into the conversation is, can you show us what your new book looks like for those who are watching the video, and maybe we'll talk about its thesis? And so it's Better Money, and then can you read what the subtitle is?
Gold, Fiat, or Bitcoin.
Okay, great. So,
and I got plugs on the back from Zuko Wilcox and Judy Shelton.
All right, they're very good, very good. So, just for the benefit of people who don't know what the thesis is, can you give them like a nutshell summary, and then we'll dive into some specifics?
Well, I've been frustrated by discussions on Twitter and elsewhere about Bitcoin and the gold standard. Gold standard people often don't understand Bitcoin. Bitcoin people too often don't understand the gold standard. So in a sense, I'm trying to teach Bitcoin to the gold standard people and teach gold standard to Bitcoin people. The first chapter is kind of laying the background with the history of monetary institutions and making the case that private institutions have been better than government institutions, more successful, that the state theory of money rests on a couple of myths. And then I get into how a gold standard works, how a fiat standard works, how a Bitcoin standard works. And then the last chapter is comparing gold standard and Bitcoin standard head to head.
Okay, well, I'm sorry, go ahead.
I was going to give away the conclusion, but...
I was going to say, why don't we wait and keep the audience on the edge of their seats? It's like Batman versus Superman. It takes a while before they actually fight. So maybe I know lots of the listeners to this particular podcast probably won't be surprised to hear this, but in case we have some people who are new to the show, have never heard this before, some might be surprised and think, well, surely one of the essential functions of the government, or they might use the term the state, is to provide the money. I mean, we've got a whole school of thought, the modern, MMT, modern monetary theory, people who say money gets its value from taxation. So
Right.
clearly money and the state must go hand in hand. And it just sounded a minute ago like you weren't aware of that fact.
Well, you don't have to go as far as modern monetary theory. Some very mainstream economists have thought of, even market-friendly economists have thought of money as somehow part of the framework, like the legal system outside the market. And within the market, we have entrepreneurs and we have market clearing and we have arbitrage and all those good things that provide goods efficiently to consumers. But they've thought of money as an exception to that. But my approach is to situate money inside the market. It's the result of market forces. And these ordering forces work well to bring about the kind of money that people want if they're allowed to operate.
So is this like science fiction, or you're just saying in theory we could imagine this, or are you saying historically actually there was this separation of money and state?
Historically, there was this separation. So as far as we know, the emergence of the use of silver is not conducted by the state. It's a market phenomenon. Early on, governments do monopolize the mint. And so that's been actually the precedent for all subsequent government intervention into the money marketplace. But I have a paper from last year, and I incorporate that and summarize it in the book about the actual historic experience with private gold mints in the United States in the 19th century. There were 3 gold rushes in the U.S., first one in the Southern Appalachians, second one in California, third one in Colorado. And in each one of them, there were private mints that sprung up to serve the gold miners who found it a big hassle and expense to ship their raw gold to Philadelphia to have it coined. Eventually, of course, the federal government established mints in Dahlonega, Georgia, and then in San Francisco, and then in Colorado, in Denver. But before that, it was a hassle trying to buy things with gold dust. People didn't know what quality it was. And private entrepreneurs said, look, we're experts at assaying metal. We will take your raw gold, we'll purify it, and we'll coin it into pieces of uniform weight and fineness, purity, and you'll have a much easier time spending it. And so we'll take a little bit to cover our costs of operation, but it's a win-win deal for the miner and for the mint. And probably the best of these mints, the Bechtler Mint in North Carolina, operated for more than 30 years, coined literally millions of dollars worth of coins, and maintain an untarnished reputation for the life of the mint. So private, even at the level of producing gold and silver coins, private enterprise can do the job.
So I think for people who they can't wrap their heads around what you're talking about here, Larry, I think some of the disconnect might be, just to make sure they understand, that there was a period in U.S. history, and it was true in other countries as well, where if you went out in nature and found some gold, and then you wanted to buy something from merchants and you showed it to them, as long as they could convince themselves that this wasn't counterfeit, like that this was really gold,
right,
and they could figure out how much it weighed and so forth and the purity and whatnot, they would be happy to sell you their stuff for that. It's not that you had to go turn it into US dollars. Like merchants were perfectly happy to take literal gold or silver in exchange for their wares.
That's right. So in California, we can track the prices that merchants would accept gold nuggets in, and there was a big discount relative to coined gold just because of the uncertainty of how pure the gold that was being offered to them was. A guy running a dry goods store is not an expert at assaying gold. But experts came in and said, we will assay it, we will stamp it with our seal, and now you can spend it much more easily. And the merchants accepted it. It's an interesting story because there were some bad actors, there were some incompetent mint masters, and there were some who seemed to deliberately put too little gold in their coin. That is, they were substandard, the coins, and they thought they would make a little extra profit that way. But they were pretty quickly found out. None of them lasted more than a couple of months. the word got into the newspaper that we've tested these coins and they're underweight, at which point people would either refuse them or they would only take them at a huge discount. And those mints went out of business. And the mints that succeeded and continued in business were the ones that were honest and competent.
And so just to be clear again, and I'm just stressing this point, Larry, forgive me, in case no one's ever heard this perspective or this piece of history before, I want to make sure that it's clicking. It's not that there were legal tender laws that said, oh, certain organizations have the authority granted to them by the government to declare that this disc is $1 or is a $20 eagle or what have you. It's that what the private mints were doing was just trying to make it recognizable to the community, to transform the raw gold into a form that in theory was hard to counterfeit or to duplicate by an outsider, to just verify to the community or to convince them that, no, this really is whatever, an ounce of gold. And you can trust us because we stamp it a certain way, and it'd be hard for other copycat organizations to make coins that look like this.
Right.
But it wasn't that they had some special legal privilege granted by the government. It was just the community came to trust certain mints that, oh yeah, their coins are good. Go ahead and test them. It really is an ounce of gold or whatever it says, 0.9995 ounces or whatever.
That's right. The private coins were not legal tender. Nobody was compelled to accept them in payment of a debt, but people voluntarily accepted them because what gave coins value was their metallic content. So one of the myths of the modern monetary theory, or the state theory of money that I criticize in the first chapter, is the idea that what makes a coin valuable is the imprimatur of the state. But that makes it impossible to explain why coins were valued according to their metallic content and not according to the imprimatur of the state or whose face was stamped on it. When official coins were debased, they traded at lower values against goods and services. In international trade, people valued coins according to their weight and not according to who they owed tax obligations to. It had nothing to do with that.
Mm-hmm. I think it's interesting what you mentioned a minute ago, sort of the exception that proves the rule, to underscore that it was like the reputation and the demonstration that these coins really were. It wasn't the stamping that, the words or the lettering or the authority behind it that gave these coins value in the eyes of the community. It was just the certification that this really is whatever the weight of gold claimed. Was that when there were mints that either through incompetence or deliberate chicanery said this is 1 ounce of gold when really it was 0.9 ounces of gold, because the listener can understand how that would be profitable for the mint's point of view if they just put in 0.9 but claim that it's a full ounce, a full bodied coin. That once people may have just tested it occasionally and then someone said, wait a minute, this coin claims to be such and such on the stamping, but it's actually not, then the jig is up. Then everyone just that quickly spreads that information, and then people know, don't take coins from that particular mint because they're not trustworthy.
Right. So the very first private mint in the United States was a guy named Templeton Reed, who was coining in Gainesville, Georgia, which is not too far from the gold fields in northwest Georgia. And very quickly, within a month of his opening the mint, somebody wrote a letter to the local newspaper saying, I've tested one of his coins and it's underweight. And Reed responds in the newspaper and gives away that, in fact, he has been overestimating the gold content of the coins because he assumed that the gold dust he was getting was 90% pure. Actually, I forget the actual number, but something really high. Mm-hmm. And it was actually only about 85% pure. So he basically self-owned that the coins were underweight. He only was able to stay in business then for about 2 months, and it only issued about $7,000 worth of coins. No big deal. And of course, the people who had his coins now had to melt them down and get what they could. So they were a little underweight, so they lost a little bit. Meanwhile, the mint in North Carolina, the Bechtler family mint, Bechtler knew what he was doing. Reed was apparently incompetent. He didn't realize what the purity of the raw gold was before he coined it. Bechtler was a very talented assayer and coiner, and his mint stayed in business for 30 years, and there were never any complaints about his coins being underweight. Somebody actually went to visit him, a traveler who wrote an account of this, and this guy said to Bechtler, look, people trust your coins now. why don't you slip in some metal that's about the same density so the coin will weigh the same, but yet it's much cheaper than gold? And Bechtler gives him two responses. He says, one, that would be dishonest. And two, I would be found out very quickly because people are always taking my coins and testing them, or sometimes people will carry them northward and they'll end up at the Philadelphia Mint where they'll be tested. And the word would get out and I would lose my business. So that would not be smart of me.
And now, do you know, like I know there's like specific, like if people just even look at their coins now, that they have like the ridged circumference, the outer edges. Yeah. And I know that's historically, they introduced that as an innovation because like way back in the day when it was just a disc when it was a smooth edge, it would be easy kind of to file off a little bit. And
right.
Even if the mint didn't do that, but like the users would get a coin and trade, and then maybe they would shave a tiny little bit off, and then over time they would just whittle away.
Yeah.
And so that's I know that's the function of the outer thing. It is so. I don't want to put you on the spot. Are there other, like how could they? What would it mean to say, oh, this mint is good at making coins for general commerce?
Well, Bechtler on his coins would tell you not only the dollar value, because he wasn't making up a new unit of account and he wasn't using ounces, he was using dollars, but dollar had a specific meaning as to how many ounces of pure gold it represented. So he put in the dollar value, he put in the number of carats, so the purity of the gold, and then the weight, and the three things had to, jibe together. One of the mints in Colorado, people complained that its coins were wearing out too fast. So they went back and changed the alloy to add harder metals into the gold. And then they had to make the coins a little heavier to compensate for that. But they did that because they cared about their reputation. So they were concerned about maintaining the quality of the coins. In the book, I quote Henry Sidgwick, the utilitarian philosopher and economist, making the argument that the externality argument long before Marshall or Pigou, that, well, nobody's going to care about the quality of the coin because people are just going to pass it on. But he's got it backwards. It's because people want to pass it on that they want to make sure that the next person trusts the coin. And because next person has to trust the coin, you have to go to a reputable mint. You can't just pass along any coin. People are aware of the value of different brands of coins.
Yeah, maybe this is a good spot to cater to the overachievers in the audience. People are, I'm sure, familiar with, or many are familiar with what's called Gresham's law, that's summarized as bad money drives out good.
Right.
But can you explain, because here, sometimes I think people misunderstand what that means, because as you just alluded to, at least in a market where there's not certain government interventions, that no, if there's coins circulating initially that everybody comes to realize, no, those things are not what they claim to be, and then there are good coins circulating that are accurate, it's not the case that everyone just uses the bad coins. And so what is Gresham's law wrong? Can you comment on that?
Well, the summary of Gresham's law, that bad money drives out good, without breaking those terms down, that's misleading. So Gresham's law, more accurately, is legally overvalued money drives out legally undervalued money. So if you fix an exchange rate between bad coins and good coins and say they have to trade 1-to-1, right? So the good coins are full weight and the bad coins are underweight. You'd be a fool to pay with the full weight coins because you can melt them down and export or sell the gold to another country and get the full value for it. But here at home, you're going to get no more than if you used underweight coins. So people will use the underweight coins, pay their debts with the underweight coins, and the full-bodied coins will disappear. So it doesn't have to be full-bodied and underweight. Another way Gresham's law can work is if you fix an exchange rate between gold and silver that overvalues one relative to the other, so the official value is higher than the market value, then people will pay with that overvalued coin and the undervalued coin will disappear. And it's not that intrinsically gold is good and silver is bad. It can go one way or the other, depending on how the market rate differs from the mint rate.
Right.
So it's an example of a price control that leads to a shortage, a very extreme shortage where the undervalued good disappears entirely.
Right. Yeah. And so I know we both know. I just want to make sure the listener gets that it involves government price controls.
Exactly.
So yes, when merchants are compelled to take a certain thing then these consequences ensue. Whereas if it really were voluntary and merchants were allowed to say, oh, wait a minute, if you try to pay me in the silver dollar coins, then I'm going to change the price tags a little bit and compensate, then you wouldn't see that preference. Like if the merchants could do a spot adjustment, just like if you were, for modern folks, if you're in the United States, that's where you live, and then you go to a Mexican restaurant over across the border, the exchange rate can vary when you're looking at the menu, and then you go to pay with your credit card and how many dollars they charge you. It's based on the exchange rate. If there was a fixed amount that the government of Mexico was enforcing, then that might lead to a situation where people would go, no, I want to pay in pesos, or I just want to pay in dollars, depending on which way the rule went. Okay, great. So maybe it's a good time then to transition. So that used to be what happened. Americans used either gold or silver, or they used dollars that were defined in terms of gold and or silver. And then at some point, everybody knows nowadays, we use dollars that are not backed up by gold and silver. So clearly, and if I read some history books, Americans came to realize that the gold standard was bad, and that's why Americans got rid of it. And we moved on to brighter and better things, like the current system. So I'm guessing you wouldn't endorse that description of history.
No, actually, there was never a referendum in which the American people voted and said, let's get rid of the gold standard. There's another big stage in the evolution of money, of course, that involves private issuers, and that's the development of banking and bank-issued money.
Mm-hmm.
And so, as you know, I've written a lot about free banking systems. So that's all fine. No individual bank can go off the gold standard.
Maybe I jumped the gun. Let's go ahead and explain. People are starting out from a framework of gold and or silver is the money. Merchants take that.
Right.
Dollars the U.S. government defines dollars in terms of grains of gold or silver. And so now, what do banks have to do with that?
So for some purposes, it's just inconvenient to carry around bags of coins, and you would like to be able to pay with bank transfers, or you'd rather have paper money that, as long as you trust it to be valued at par, at full value in terms of the gold or silver that it's redeemable for. So those are banknotes. Banknote is a little contract that says we'll pay the bearer on demand. And as long as the bank really will pay the bearer on demand, a bank can establish a reputation for doing that, and people will accept its banknotes. And that's a system that continues to be on a gold standard because, as I was starting to say, no one bank can change the monetary standard. If a bank fails to redeem, that bank goes out of business, and the other banks carry on with the gold standard. And that was the United States system up until the Federal Reserve Act. Banknotes were issued by competing commercial banks, although under the National Banking Acts established during the Civil War, there were restrictions on what the commercial banks could do, which weakened the banking system. That's why we had financial panics. When the Federal Reserve Act is passed, the Federal Reserve is just one issuer among many, and the Federal Reserve is also on a gold standard. It's obliged to redeem its notes for gold. But in the 1930s, I don't know how deeply you want to go into the reasons, but the national banks had the right to issue notes taken away from them. So now the Federal Reserve is the only issuer of paper currency. And so when the Federal Reserve, at the behest of the Congress and the president, says, we're not redeeming anymore, and this is actually backed up by the Congress and the president saying, in fact, Americans aren't even allowed to hold gold coins anymore. You got to turn them into the Federal Reserve System. Now we're on a paper money standard, and it's hard to stay on the gold standard when you're not even legally allowed to own gold coins, much less are banks allowed to issue claims redeemable for gold anymore. So we switched to a paper money standard where the dollar is now irredeemable, at least for domestic citizens.
Can I stop you for a minute, Larry? Yeah,
sure.
So this is, I think, an important point, and I was guilty of this. I think some people, when they start getting sucked into the gold bug vision of history, they think the critical date is in 1971, and that's when everything changed. And before that date, the dollar was backed up by gold, and then after that, it wasn't. But as you're pointing out here, well, no, there were stages of things, and there was a sense in which the gold standard, the classical gold standard that existed like before World War I, was significantly weakened by the year 1938, even though at that point, if you said, is the dollar backed up by gold, people would have said yes.
So the dollar was, in a sense, backed up by gold, but only foreign central banks were allowed to redeem dollars for gold at $35 an ounce under the Bretton Woods system that was put in place during World War II. The international gold standard was dead. It was now an international dollar standard because other currencies were backed by dollars. So if you went to the Bank of England with a Bank of England note, you could redeem it for dollars, but not for gold. And likewise in other European countries. So now the gold standard is hanging by a very thin thread, which is the willingness of the United States to maintain the dollar at $35 an ounce. And that's a constraint. And eventually they get tired of the constraint. So in the 1960s, the Fed stops behaving as though this is an important constraint. They start issuing more money than is consistent with maintaining redemption at $35 an ounce.
Can I stop you, Larry, again, just to make sure people aren't missing the hit? Because I know you and I know this stuff, but I want to make sure we're not losing the listeners. So again, the critical thing in the early 30s when Roosevelt first comes in is you have to turn in your gold under penalty of law, and there were significant penalties.
Right.
So Americans are no longer walking around with gold coins in their pockets or even in their safe deposit box.
Americans held very few gold coins at that time. They were mostly using checks and banknotes. But the most important thing was commercial banks had gold reserves, and they had to turn them over to the Fed. And the Fed was regulating them, so that was hard to evade. Some Americans held on to their gold coins, but they couldn't use them publicly anymore.
Okay, great. All right, yeah, so thank you for that clarification. So, but the important thing was before Roosevelt, anybody in principle could go turn in the dollars to get gold.
Right.
And then after Roosevelt's actions, nobody else. And then certainly when it was tumultuous, but then clearly in the post-World War II Bretton Woods era, at that point, only official institutions like foreign central banks could do it.
Right.
And then now you're saying, and then in the 60s, even though the Fed knows the only body who can possibly call our bluff is other central banks, that's why they started, some would say, printing more recklessly.
Right.
Because they thought, as long as these foreign central banks were the only people who could even call our bluff, as long as we can convince them, no, this is
we
good
can
for
twist
all
their
of us.
arms not to redeem. So the U.S. was, in a sense, through NATO, defending Europe. So they would say to foreign countries, if you redeem your gold, we're going to kick you out of NATO. And finally, France said, okay, kick us out of NATO.
Can I ask you, Larry, was that, you're reading between the lines, or I don't know this particular part of the story, or was that no, we have cables or memoranda and stuff? How explicit was that threat?
Well, that's a good question. I don't know exactly what the primary source material is, but I think it was pretty clear at the time.
Okay, you're confident in saying that's what everybody knew the deal was. Okay.
Yeah, and France did leave NATO temporarily.
Okay, geez, I didn't even know that. Okay, I'm learning stuff from the Founders Forum. This is great. Okay, so is that too when people say that? And I know people are complaining. Then France, did they actually get caught and pull their gold out?
Yeah, but they weren't the only ones. Britain, Germany, others were redeeming, and so the amount of gold available for redeeming was shrinking and shrinking. Lyndon Johnson put new restrictions on redemption, and he stopped supporting the private gold market in London, because the U.S. was buying dollars as necessary to keep the price at $35 an ounce in that market too, but they stopped doing that. So now there's a floating price of gold that's in the 40s, like $42 an ounce. So now foreign central banks have an arbitrage opportunity. Get the gold at $35 an ounce, sell it at 42. So that's hard to resist. But eventually Nixon shuts the gold window in 71. He had a choice. He could have tightened monetary policy to the point where the dollar was worth 1/35 of an ounce of gold, but he was running for re-election. He didn't want tight money. He wanted loose money. And that we know from the tapes. I mean, we have it on tape.
Right.
That was on his mind.
Now, I know in the official announcement he made, it was just a temporary measure.
Yes. He blamed it on speculators, of course.
Yeah. So at what point did the dollar get retied to gold? I don't remember that part.
That didn't happen.
Okay.
They tried to create a substitute for Bretton Woods without the gold, which they called the Smithsonian Agreement. And that lasted about 18 months.
Okay.
Because European central banks didn't want to accept unlimited numbers of dollars without even a fixed exchange rate into gold.
I don't know how big a deal this was, but I know there were at least some Keynesian economists that thought the dollar, like, right before Nixon did that, they thought that the dollar was, the strength of the mighty dollar was holding up the price of poor little gold.
Yeah.
And they predicted that, I guess that the dollar price of gold would go below 35 once the link was severed. But
well, Milton Friedman made that prediction. And
he did too? Okay, I didn't know that.
Yeah. But it was premised on the U.S. selling off its gold stock, which
so he
never
thought that would crash
happened,
the
to
price.
be fair.
Okay.
Yeah.
Okay.
But right, others predicted that price of gold would fall.
Okay, so that's
not what
in
happened.
fact what happened. And then
Right.
we also, coincidentally, the 1970s saw a lot of consumer price inflation after arguably the Fed's hands were untied. By the way,
the inflation had started. The
Mhm.
inflation had started in the 60s, right? So annual inflation rates were creeping up. In 1960, it was like 2%, but by 1969, it was 5%.
Mhm.
And 71 is as much a symptom of that inflation and Nixon's unwillingness to stop it by tight money.
Okay.
So it's not exactly clear when the Fed stopped paying attention to the threat to their ability to redeem, but sometime in the 60s, they stopped acting like Bretton Woods was a constraint.
Okay. So do you know, or not do you know, but in your book, I've seen some people say, oh, what happened was they tried with Bretton Woods, technically the U.S. still had to redeem with foreign central banks, so they couldn't be too outrageous with it or too reckless, but that in the late 60s, like we had the Great Society for the War on Poverty, and then of course the Vietnam War, and it was just fighting both a foreign and domestic war simultaneously. There was too much deficit spending that was necessary. The Fed indirectly was monetizing some of those deficits, and that it was just unsupportable. And Nixon threw in the towel. Are you okay with that general narrative, or do you think that is
I wouldn't
misleading?
place that much emphasis on the fiscal side of it, because if you look at the amount of debt monetization, that's not the real change. The change is the Fed is seduced by Keynesian economics, and they're willing to tolerate higher inflation because it's reducing the unemployment rate. They're playing the Phillips curve, and you see that in the data, that the annual data line up on a Phillips curve slope the way you expect up until 1969. So inflation's going up and up, unemployment's going down and down. But then the public wakes up, inflation expectations adjust upward. We're not living under the gold standard anymore. There's not going to be any correction of this inflation. We're under a gold standard. If the price level goes up, you expect it to come back down, because it's a mean reverting system. But people woke up to the fact that that's not happening. And so when they adjust their inflation expectations, when workers start building in cost of living increases into their wage demands, then you can have high inflation and high unemployment. And that was the famous stagflation of the 70s.
Okay. At this point, should we jump ahead to the Bitcoin white paper, or is there an intermediate piece that we want to cover?
Yeah, so we can jump ahead. I've got a chapter on kind of the supply and demand dynamics of a gold standard. I got an extra chapter on misunderstandings of the gold standard.
Sure. Yeah. Well, yeah. Can we? So the conventional view, even among a lot of economists, would be, yeah, the gold standard, it was good for its era, but it led to a lot of shortcomings. Certainly, if there was a crisis, like an economic financial crisis, it tied the hands of the central bank. We know now, as good trained macroeconomists with much more experience, we don't blame the people back then for not knowing this, but what could they do? We know now that the role of the central bank when there's a crisis is to flood the market with liquidity, be the lender of last resort, so on and so forth. If there's a liquidity trap, you got to have the government come in and run a deficit too, but put that aside. And so, yeah, you don't want to be on a gold standard and have enforced austerity when really what you need is fiscal liberality. And so thank God we're not on the gold standard anymore. Like if the U.S. government had still been on the gold standard in the fall of 2008, we would have had a second Great Depression. Fortunately, the Fed was able to flood the markets with liquidity, have the QE programs, and that spared us a disaster. So that's a lot of economists, I think, would generally agree with what I just said. How do you feel about that?
No, I think you're right. Probably a majority would agree, despite the fact that Kydland and Prescott got a Nobel Prize for pointing out that if you can constrain the central bank, you can get better results. even from the central bank's point of view, right? That there's a value to pre-commitment. If you're not pre-committed, then you get into this race to the bottom where the public starts to expect higher inflation and the central bank has to satisfy what they expect or you get a recession. So you get into this negative feedback loop or a bad equilibrium where the public expects high inflation and the central bank says, well, if we don't give it to them, we're going to have a recession, so we better give it to them. And then all you get is high inflation. You don't get lower unemployment. You don't get dampening of business cycles.
Okay, so just to make sure the listeners caught that nuanced argument, you're saying, according to this Nobel Prize winning work, if everybody knows ahead of time, it is simply not an option. It, like maybe constitutionally or at least from statute, the central bank does not have the authority to just come in as a lender of last resort and just buy up a bunch of mortgage-backed securities or whatever.
Right.
Then that changes people's expectations and their behavior such that the economic ramifications of a tight monetary policy aren't as bad compared to the alternate scenario where the Fed does have the ability, if it wants to, and just chooses not to. Then that's really where bad things happen. If the public assumed, all this liquidity from the Fed was coming in, and then they, for whatever reason, turn off the spigots, that's really what causes a huge problem. Whereas if everybody knows 10 years ahead of time, no, the Fed, this is just even on the table, then the outcome's not as bad.
Right. So if everybody knows that the Fed is prone to open the spigots, that it doesn't have much effect when they open the spigots because it's already priced in. People are already demanding higher wages and prices and rents and so on.
Okay, so I guess the obvious question then was, but Larry, come on, as you just said, the U.S. used to be on the gold standard and all the major powers were, and now nobody is. So what, everyone was just stupid? Like why, if it's so great, why doesn't some of them go back on the gold standard and then show everyone how great it is and outperform them?
Well, it's a historical path that leads to where we are today. And it's hard to go back because loose money is always easier in the short run, more pleasant in the short run than tightening monetary policy. But central banks are, part of the government, and the government that doesn't want to be fiscally constrained doesn't want to have the hands of the central bank tied in case they need the central bank to monetize the debt they're generating, or even, in the basket case countries to directly pay the salaries of public employees by printing money. We're not quite at that stage yet in the US. We do it the polite way, where we first run the debt and then we have the central bank buy the debt, rather than have it just one step, the central bank prints the money to pay the government's bills. But it works out to the same thing.
Do you want to speak a little bit, like just in terms of just the operations, like what were the virtues of I don't know if you want to say the classical gold standard? Is that the period you want to address?
Yeah, I mean, that's where I do emphasize the classical gold standard. And in a paper 10 years ago now, George Selgin and Bill Lestraps and I compared the track record of the Federal Reserve System to the track record of the classical gold standard in the United States. And even though the banking system was pretty weak in the US and we did have financial panics, business cycles were not any worse then. Or to put it the other way around, the Fed has not improved the performance of the real economy. It has not dampened business cycles as measured by variation in real output. Real output is as volatile now as it was then, and inflation is higher. So we haven't really gained by instituting a central bank and going off the gold standard. We haven't reduced business cycles.
And besides your sophisticated regression analysis or whatever,
well, that was Bill Lestraps.
You use, just anecdotally, the Great Depression, the Federal Reserve Act is what, end of 1913.
Right.
So the Fed's clearly up and running, has had plenty of time to, get its stride.
Well, if we include the Great Depression, the Fed's track record is much worse in terms of the volatility of output. But even if we say, well, that was just practice, right. We won't count that against them. Even if we just start in 1971, the economy's not any more stable than it was in the classical gold standard period, which is weird because the economy's much more diversified now than it was then. Right? We were pretty much an agricultural economy before 1913, and now we have a much more diversified economy. So you'd think output would naturally be more stable, but it hasn't been.
Right. And theoretically, with the introduction of more sophisticated futures markets and other derivatives and things, arguably that should have helped with the spreading of risk and blah, blah, blah. And yet, as we say, the Great Depression clearly was on. So the Fed was up and running for 15 years when the 29 stock market crash happened.
Right.
And then, when people say, okay, what's the second worst calamity? A lot of people say, oh, well, it's the so-called Great Recession. It started in how you date it, 2007, 2008. Again, clearly on the Fed's watch after they said, okay, Great Depression, that give us a mulligan on that one. Now we know what we're doing, won't happen again. And oops, after the Great Recession, okay, now for real. This time we mean it. We're not going to crash the economy again.
Just personally, the Great Recession was good for me because up until then, nobody was teaching monetary theory at George Mason. Well, they had people teaching the course, but nobody specialized in research on money and banking because they didn't think it was important. The Fed had it all figured out. Great moderation. It's not important anymore. But that convinced them that maybe they should have somebody on staff who specialized in money and banking.
What's good for Larry White is good for the United States, right?
Well, so if you specialize in monetary pathology, then you're well insulated. You're well hedged against bad events.
Okay, so I kind of interspersed with my jokes and whatnot, but your conclusion that you did reach in that paper was to say, even if we're bending over backwards to be fair and throwing out major calamities, still the track record of, and this is not using Cato Institute time series data. This is like standard, stuff in the literature, that the performance of the Fed in terms of, reducing volatility and or keeping price inflation low and predictable, it's clearly you can't say that the Fed period is better than the pre-Fed period.
Right. And one kind of subtle difference that people miss is that under the classical gold standard, where the price level is anchored by the economics of gold mining, by a decentralized market, so the price level is more predictable. It's especially more predictable at 10, 20, 30-year horizons. So you see a lot of long-term bonds, 50-year bonds, railroads issuing 100-year bonds. Nobody can do that today because who knows what the dollar is going to be worth that far out on a fiat standard. And so you get a less deep financial market under our current system. And that encourages more short-term thinking and less long-term investment. It's hard to quantify that, but that's a real problem.
Right. Yeah, and ironically, that's one of the charges that's often laid at the feet of unrestricted laissez-faire capitalism is it encourages short-term.
Everybody's worried about next quarter. That's right.
Right. Whereas you're saying that, well, no, when the money itself was more predictable and people knew what's the purchasing power of the dollar going to be 50 years from now, then long-term bonds made more sense. Whereas now, you'd be nuts to lend money to the government for 50 years because who knows what the heck that's going to buy when they pay you back.
Right. And you can see the same thing across countries today. You can't get a 30-year mortgage in Mexico in Mexican pesos. Who knows what they're going to be worth even 30 years from now. But the U.S. has made its own financial system more shallow by going to unpredictable fiat standard.
And I know the British government at one point issued consols that were perpetual bonds. That, you just gave them the principal and they would just pay you interest forever. That in principle with an LE, they would never redeem the thing. It would never mature.
They have started retiring those, by the way. They are callable.
I can imagine. Okay, so is it a good time to start talking about Bitcoin?
Sure.
All right. Bitcoin. What's your reaction? Good or bad? What do you want to say about it?
To the extent that people want to use it, it's great. And it does have an important use case, which is it's a way to make payments, especially internationally, that doesn't go through the banking and central banking controlled payment system. So it's censorship resistant is what Bitcoiners like to say. And the example I always use, which I get from a guy named Alex Gladstein, is if you want to send money to a dissident group in, let's say, Belarus or Nigeria or wherever, you can't wire them dollars because the government won't let them have a bank account. They're enemies of the state. The payment's not going to get there. It's going to be censored by the central bank. But you can send them Bitcoin. The government can't stop that or doesn't stop that. And they can sell the Bitcoin locally to fund their operations, pay their staff or whatever. So that's the great use case for it. It's a kind of a niche use. It's not yet become a commonly accepted medium of exchange. And part of the big argument in chapters 5 and 6 is that Bitcoin is inherently, due to its design, more volatile in purchasing power than a commodity standard. In a commodity standard, if the demand goes up and the price starts to go up, you get a quantity response, you get a supply response. Miners will dig a little deeper when the value of gold is high, and that'll bring it back down, assuming that the costs of extracting gold haven't changed in the meantime. So the purchasing power of money under a gold standard is self-correcting or mean reverting. Whereas under Bitcoin, the quantity doesn't respond at all to changes in the market value of Bitcoin. It's designed to have a pre-announced release schedule, so we know how many Bitcoin there are going to be, more or less within a percentage point or so, on any date, and that quantity is not affected by the price. And that means changes in demand are fully reflected in the price and not at all in the quantity. So in the short run, both Bitcoin and demonetized gold, which is what we have today, are a little bit volatile, although Bitcoin is about 7 times more volatile than gold. So they're both demonetized. If they became money, they would be less volatile, but the gist of my argument is that in the long run, the supply curve of gold is pretty flat. That is, you're going to get changes in quantity to satisfy changes in demand, not changes in price. Whereas in Bitcoin, it's all in the price. And there's lots of statistical evidence that Bitcoin is not becoming any less volatile over time. And that's because the supply curve remains vertical over time. There's no change. And the demand is mostly speculative, and that hasn't changed. So if all
So
the
can I
money...
stop you, Larry,
Sure.
just to make sure people understand, in case people aren't familiar with the technicality. So you're saying, I'm making up numbers, if for some reason in the near future, there was a sudden huge demand to hold more gold, everybody's scrambling to add gold to their portfolios, central banks maybe are trying to add and so forth. In the short term, that would just cause the price to go through the roof. So maybe it goes up to whatever, $50,000 an ounce.
Yeah.
But then that sends an immediate signal and people around the world start mining more gold. So the annual production of new gold brought to the surface of Earth
Right.
and then added to people's holdings is going to be a lot higher. And that eventually is going to make the price come down. Whereas if the demand, all of a sudden people read about Bitcoin and understand its utility, and the demand to hold Bitcoin surges, and so the price jumps up to 100,000, that will suck more computing power into mining. But the way the Bitcoin protocol works, that will just automatically increase the difficulty of the math problems that the computers have to solve to mine more, so that the trajectory of new Bitcoins entering human possession over the next 2-3 years won't be any different from the original trajectory. Whereas with gold, again, if the price is through the roof, a lot more gold is going to get brought to the surface over the next 3 years than would otherwise be the case.
Yeah, so calling the transaction validators in Bitcoin miners is misleading. They get a reward, which is why it's called mining. But if you have more Bitcoin miners, it doesn't mean they're producing any more Bitcoin. It just means more people are competing in this lottery to solve the math puzzle that gets them the reward.
Yeah, it would be as if
isn't any more reward given out.
Excavators start looking for gold if the gold somehow knew that and went towards the Earth's center or something to automatically offset that perfectly.
Right. Now, the response of gold is slow, to be fair. I mean, so if the rate of gold production goes from 2% of the existing stock to 4%, it's going to take a number of years if there's a big demand increase to satisfy that demand with increased quantity. But it's something. It does mean that the price level is going to come back down, even if it takes 10 or 20 years. People knowing that will look ahead, and so the price of gold won't go up as much as it would if there were no knowledge that it's coming back down. The knowledge that it's coming back down restrains the height the price is going to reach in the short run.
And it would also, too, like if it was a really ludicrous high, like the numbers I was throwing out, like people would go and find their old gold jewelry in the attic and stuff and go turn that in, and it would get melted down. And
no, in the short run, people actually do that. This surprised me because it was much bigger than I thought it would be. But the World Gold Council says that the flow supply of gold into industrial uses and making new jewelry and coins comes about a third from recycling gold. That is people melting down their old jewelry.
Yeah. Okay. Great. So, big picture, we got about 10 minutes if you're able to still stay on for that long, Larry. Can you speculate as to, do you think in the year 2100, people are going to be using Bitcoin or perhaps a different cryptocurrency as the money? Or what are your thoughts on that? With any caveats, obviously, you want to give.
Yeah. So, as I said, Bitcoin has this niche use as a censorship-resistant means of payment that people will occasionally want. So it may stick around. But I don't foresee it being widely accepted or adopted as a medium of exchange just because it's so volatile. And the volatility is there because the supply is predetermined. And the supply is predetermined, that is, it's written into the code to assure people that Bitcoin's not going to be hyper expanded. There isn't any issuer who's going to pull the rug out from under you. So it does serve a purpose, and it helped get Bitcoin launched, but it's a limitation to its being adopted as a medium of exchange. So if all the fiat monies break down, it seems to me more likely that people will move back to a gold standard, right, from the bottom up. But there's another possibility, which is there are other designs for cryptocurrency that would not have this same feature of great volatility in price and no response in quantity. So people are just now starting to launch what they call flat coins, which have feedback from the price level. So it's not a stable coin. Doesn't say it's going to be worth $1. Flat coin means it's going to be worth $1 plus whatever extra is needed to offset inflation in the dollar. And so it's indexed to the CPI bundle. So there's one called Nuon and there's one called Spot, but they're actually hard to get. They're not on the regular exchanges yet. They've just been launched. Disclaimer, I'm consulting on a project with a different design, which is basically to replicate the features of a classical gold standard by having a coin whose quantity increases when the price goes up and decreases when the price goes down in order to keep it reverting to a flat path. And
so it's price measured in what?
Well, on the exchanges, all the coins are priced in dollars. So we got to take the dollar price and then adjust by the CPI or some combination of the CPI and the GDP deflator.
Okay. So that particular one that you're talking about,
it's called Prasaga. If I can plug
it shoots to maintain a constant purchasing power of the Prasaga coin vis-a-vis the US CPI basket?
Yes.
Okay, so are you thinking then, and again, I know it's hard to say, it depends what regulation happens and so on, but do you feel like in the year 2100, Earthlings are going to be largely using blockchain-based media of exchange, or do you think it's still going to be, or maybe that's not the right dichotomy, maybe even the states use blockchains too at that point?
Unlikely for states to use blockchains unless, in the sense of anonymous blockchains, because they don't like anonymity.
Okay.
Right?
That limits their abilities to
surveil
track
people.
things and
yes.
Okay.
Prevent tax evasion and so on.
How do you, again, I don't know if this is
I don't know what probabilities to put on fiat monies breaking down, but
let me
no paper money has lasted forever.
So putting aside the issue of whether this would happen or not, just in terms of you evaluating the monetary systems. So it sounded like you're saying the classical gold standard was a better system than the paper fiat money state system, system. What do you feel about how does if everybody were using, I don't know if you want to say Bitcoin or if you want to say, well, there's problems with Bitcoin with the transactions volume, if you had a different cryptocurrency that was more elastic, but however you want to answer, but how do you compare the crypto regime as a possibility versus either government fiat or classical gold?
If governments will allow crypto entrepreneurs to test these different ideas in the marketplace and people are free to put themselves on whatever standard they want, then we have that waiting for as a sort of a plan B or fallback plan should fiat monies become unstable. So if the dollar can maintain 2% inflation, I don't see any big groundswell of people abandoning it. It has a lot of momentum built into it because Everybody wants to be on the monetary standard that their trading partners are on. It's not in any one person's interest to go off that standard and adopt something else that increases their transaction costs every time they want to make a transaction. If we look at when people do spontaneously switch money, if we look at dollarization from the bottom up, it seems to take an inflation rate of, 20% before you see a lot of spontaneous dollarization.
And to be clear, your dollarization, you mean because if we look at other countries that originally weren't on the dollar, when their local currency, when the people are suffering from 20+% annual rates of their consumer price inflation, people start using US dollars as a backup.
Yeah, they start keeping their savings in dollars for obvious reasons. They start posting prices in dollars because that way they don't have to change the price tag every day. And then they start accepting dollars first for big ticket items, and then eventually this is where Lebanon is now, for everyday items. Grocery stores in Lebanon now are insisting on being paid in dollars, not in Lebanese pounds.
And that's because Lebanon has been suffering from hyperinflation?
Not quite hyper, but very high inflation. I mean, it's not 50% a month, but it's more than 100% a year.
Wow. Okay. So you think it's a matter of, but so there you're just explaining what would divert people. But suppose people could magically, all of a sudden, everyone's using Bitcoin next year on planet Earth.
Yeah.
The performance of that system relative to the one right now where everyone's using either dollars or euros or yen. Do you have any comments on, are you able to evaluate that trade-off or head-to-head?
Well, there are some pluses to having a monetary rule that is very strict, which is what Bitcoin has. But I think it's the wrong rules, this completely fixed quantity of money. So it would be nice to be able to combine a strict rule with an elastic supply. So elastic supply doesn't mean some people in authority get to add however much they want. That's the system we have now. But according to some formula that's known and public and unalterable, will respond to changes in demand with changes in supply, and thereby make it a more stable money that's more reliable for long-term contracting.
I'm curious, would your, and maybe, I don't know if this is maybe the last question I'll ask you, given your affinity for so-called free banking, is your ideal system one, or maybe would a pretty good system be one where the actual underlying base money is Bitcoin, but then you've got banks that can issue redeemable notes or electronic deposits that are claims on Bitcoin, and so that if the demand to hold the money goes up, then the banks just issue more claims on the underlying Bitcoin?
Yeah, that would be a big help to a Bitcoin system because it would dampen the size of the swings in demand. And as you say, the banking system could satisfy increased demand to hold Bitcoin denominated media of exchange, as long as the public is satisfied by bank issued and doesn't want the base money itself. So yeah, a free banking system does help stabilize the purchasing power of money. Mises talks about this in the Theory of Money and Credit.
Okay, so all in all, I don't know if you have any final comments. Do you want to leave? I suppose, again, this podcast, Founders Forum, it's for business owners. I don't know if you have any words of wisdom to what should business owners be looking out for. If someone doesn't really know much about Bitcoin, is it at the point where, you really need to at least learn the basics of this just so you're not caught flat-footed?
Yeah, I think you should learn the basics. And right now, the product in the crypto space that's probably most useful to businesses are stable coins. So these are dollar-denominated Tether and USDC tokens, which you can buy and sell on exchanges. And it's a cheaper way to make payments than wiring money. So this consulting project I'm involved in, it's run by a Swiss foundation, and they pay me in USDC because it's easier for them to do that than to try to put directly deposit money in my bank account. It's just cheaper and faster. And that applies to lots of businesses, I think, especially if they make international payments. That's probably a useful product for them to know about. You do have to do some diligence. The balance sheet of Tether is pretty opaque, and both Tether and USDC have pretty thin capital. USDC almost depegged. Well, it did depeg during the weekend where Silicon Valley Bank failed. because they had more money in Silicon Valley Bank than their capital. So if their deposit had been wiped out, they couldn't have maintained $1 per USDC coin. So
now, I'm curious, do you know, was it just that it temporarily traded below? Because I know back in May of 2022, when a lot of stuff was going on with the stable coins, that some of them temporarily traded below par, but it wasn't that, I saw the representatives of the company say, it's not that we reneged on any of our redemption pledges. It's just in the secondary market, it temporarily, we can't control what people sell it for. So when you're saying it temporarily, do you know, was it they literally, like, someone tried to redeem it and they said no, or just the secondary?
They did halt redemptions for that weekend.
Okay.
But we know that they have said that we had, I forget what the number is, so many millions on deposit at SVB in uninsured accounts. And that amount, if you look at their balance sheet, exceeds their capital, exceeds their net worth. So they wouldn't have been able to pay everybody 100 cents on the dollar if they their deposit hadn't been bailed out.
Okay, so
Tether, we don't know exactly where their money is. And ironically, people moved into Tether. They escaped the devil they knew and embraced the devil they didn't know.
Okay, so I know I've seen their balance sheets and whatnot, and you're saying, well, you can't dive into the specifics.
The capital is less than 1%. That's what I'm emphasizing.
Okay,
I'm hopeful that more competition will bring more scrutiny, and that'll bring more transparency and higher capital ratios. Now, when interest rates were 0, there was no way for them to make money because they're earning so little on their assets, unless they were highly levered. But now they're getting 5% on short-term money, the way everybody else is. They can afford to have a higher capital ratio and still earn a decent return on equity.
Okay, so your overall conclusion is for the business owner who doesn't, I know at some point I should look into this stuff, but they're just running their business and they get paid in dollars or euros or whatever. You're saying it's worth it to start looking at this stuff because at the very least, it may make sense for you to start accepting stable coins, especially from foreign suppliers or customers. Yeah. But just do your due diligence. You're not giving a blanket endorsement. You're just saying, nothing right now is perfect. And so just be aware of what you're getting into.
Some businesses have sort of jumped ahead and say, we'll accept payment in Bitcoin. But as far as I know, they're not doing a lot of business in Bitcoin. So Overstock.com was an early adopter of Bitcoin as a payment medium. And when they're asked, well, what percentage of your merchandise do you sell for Bitcoin? It's a fraction of 1%. So that's not a big advantage for businesses right now.
Okay. All right. Fair enough. Kate, can you hold the book up again? So the
Better
book
Money.
is Better Money by Larry White. My guest has been Larry White, economist, expert on money and banking. Larry, thanks so much for your time.
Thanks, Bob.
And thanks everyone for tuning in. Next episode, Cole should be back, and we'll see you then.
This concludes another episode of the Founders Forum. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the hosts and for previous episodes, visit foundersforum.io. Thanks for listening.